Welcome to Taking Stock. I'm Amanda Lang. Coming up, we're sitting down with former Bank of Canada Governor Stephen Poloz to talk about the economy and the outlook for Canadians, including how we got here and the risks that lie ahead. That's all coming up. But first, let's start with how we got here. By here, we mean a central bank fight against inflation that may or may not cause a recession. Here's a look by the numbers. Interest rates are high in Canada in an effort to fight inflation. It clocked in at 3.8% in September, while spending, as measured by retail sales, dropped slightly in August. Part of the juice to the economy came in the pandemic. Federal government spending that totaled $576 billion, according to the Parliamentary Budget Officer. Though the PBO notes that about a third of that, or $204.5 billion, had nothing to do with the pandemic. That largesse made households wealthier and spurred spending. By the end of 2022, disposable income for all Canadians was up 16.7% compared to prices. That increase in spending power was a contributor to inflation in Canada, and combined with global supply chain issues, sent inflation to a high of 8.1% by June 2022. Higher prices, combined with the end of COVID benefits, meant purchasing power for households fell 5.7%. That decline in purchasing power was worse for those in the bottom 20% of incomes. Disposable incomes there fell 25%. By contrast, the wealthiest 20% saw disposable incomes fall just 0.5%. Higher rates are intended to cool the economy, which seems to be working. GDP in second quarter contracted slightly. The PBO expects rates to stay elevated until at least next April and then start falling gradually. Well, for a lot of Canadians, where we are is more important than how we got here. But understanding the pieces of that particular puzzle can help us figure out what might come next. Stephen Poloz was Canada's central bank governor from June 2013 to June 2020. He's a special advisor with Oslers and author of the new book, The Next Age of Uncertainty. Thanks for being with us.
A pleasure. Thanks.
So this question of how we got here, I know there are a lot of moving parts, but the one I want to focus on does go back to the state of interest rates for a long time leading up to the pandemic, which is to say they were low. Post-credit crisis globally, they got low, they stayed low. It really did encourage borrowing. Is that partly what contributed to inflation, or in any way contributed to inflation?
Well, I really don't think it's part of the contributor to inflation, but it does create imbalances in the economy that then, when interest rates normalize, cause a certain amount of discomfort or pain in some cases. Inflation, is part of the picture, but of course, most of that happened from the outside. When we go back to the beginning, when interest rates were really low, we were trying to offset other headwinds to the economy. Basically, we were trying to make sure that inflation stayed up at 2%, and that was largely achieved. Therefore, the objectives were met. But of course, part of that then is the side effects which go on. And when we reach the stage, which we've done in the last year, where interest rates normalize and then more than normalize, well, that, of course, gives a major adjustment to the economy. All this to say that inflation is best avoided, but of course, when it comes from something like an invasion of Ukraine, it's not avoidable.
And I guess on that front, if we cast our minds back, there was that period of time that went on for months when central banks said, if this inflation is transitory, that transitory word that became so familiar to us all. Economically speaking, maybe it's still considered transitory. I don't know. But what would you say about the kind of lag in central banks saying this isn't going to go away on its own? We actually do have to take action.
Yeah, well, that's, really transitory, I think, was an unfortunate term. It's one economists use all the time. It's a technical term that doesn't really capture the reality of price adjustments in the real economy. Transitory to an economist is something that will more or less go away on its own. But in a case like this, it would be something that would last, say, 18 to 24 months. And indeed, that's exactly what has happened. That the 5 percentage points boost to inflation that came from the Russian invasion of Ukraine has more or less washed out of the system. The complication that comes along, Amanda, is that as that exogenous inflation pulse goes through the system, some of it can stick. It can get captured in domestic inflation processes. It can get captured in domestic inflation expectations because you can't expect ordinary citizens to make all these distinctions. They just see higher prices. And so when it does stick, that means then the central banks have the extra domestic challenge of working that down. We were always going to get an inflation above target in 22 anyway, because as we saw in the aftermath of the pandemic, all central banks waited until they were absolutely certain that the risks of the second Great Depression were well behind us before beginning to normalize interest rates. And that meant that we were going to blow through the 2% intersection. That would be not a big deal at the moment. We'd have maybe 3.5% inflation.
Right.
That wouldn't be hard to work down.
One of the things, of course, that happened, and with a lot of this, we obviously know more in hindsight, and history will help us. And the next time a global pandemic comes, maybe we react differently. But we saw, of course, government support max out. Our government sent billions and billions to consumers and to businesses. And as we know, and as you would have known, likely even before you left in June 2020, household balance sheets were actually strong as a result of that, not weak from the pandemic. If we could go back as a central banker, would you advise against that? Would you say send less home because it will create this kind of artificial demand?
Well, hindsight is perfect, I think, and I do look back on it and wonder if maybe we could have been more calibrated in that response. You'll note that in the United States, for example, the fiscal policy that was put in place was even less fine-tuned or calibrated than it was in Canada. People just got checks, whether they were, even if they were living outside the United States or, and so on. And just got a check and that's it, that's all. Whereas here, we had a more elastic kind of setup where, for CERB in particular, if you lost your job, then you would apply for it. By the end of the week, you were on it. You got your $500. That was a very flexible instrument. And it meant that we only spent what was necessary to be spent to support the people that actually lost their jobs. So I think that was a pretty good thing to put in place in just a short period of time. Could it have been more finely calibrated? Well, of course it could have been, but that would have taken a lot more time and meant more of a filter to get it in action. And I'm not sure that was the most important thing at the time. At the time, the important thing was to get things moving so that we did not collapse into the tragedy of a depression, which we had all the ingredients present.
If we fast forward to today, of course, central bank action seems to be working. We are seeing inflation cooling. Maybe, again, that's external factors. But we definitely are seeing kind of some of the demand side picture here in Canada responding. One question I would ask you, and I know former central bankers, there's a bit of a code about not commenting on existing bankers and what they're up to. But just almost on a theoretical level, at a certain point, might we consider changing the target? It's at 2%. I know a current central bank could never say this, but is there a point where we might say we live in an inflationary environment, that some of the forces of the green transition and demographics are naturally inflationary, and 2% is just too low?
Yes. Well, I've heard that argument a lot, Amanda, in all my public activities in the last year or two. And I think when we go back to basics, and this was not something we decided forever, 40 years ago or 30 years, so it was about almost 40 years ago. We decided it again and again over those years. We considered raising it, we considered lowering it. We kept settling on 2% because it's the place where inflation kind of becomes irrelevant to people. They don't even think about it. But as soon as it's around 3 or 4%, they think about it a lot, and they begin incorporating it into their planning, and whether they're a business or an individual. And so that means it's distorting things. And so that's the whole point of that number. Now, that doesn't mean necessarily, and we know from experience, it doesn't mean having 2% inflation every day or every month forever. We've had lots of periods where inflation has been 3% or a little above and then worked its way back down, and it's been close to zero, well below where it should be, and then worked its way back up. So we know that we can tolerate these kinds of deviations. And so the question is, how fast do you need to get it back? And I think that's a question worth discussing in the environment that you're describing. The longer it is above normal, then the more likely it becomes embedded in people's expectations. We know that. And that, of course, means that you have all the counter arguments that I just made. So, but it's a very hard judgment to make. And I think it is worth at least discussing that pace of return. It could be a case where opportunistic disinflation over the next, say, 2 or 3 years would be sufficient to get us back on track. Whether the pain of getting there more quickly is worth it is a really hard judgment call. Certainly not one for me to make from here.
All right, we're going to take a quick break. When we come back, more of our conversation with Stephen Poloz and the questions of affordability. Stay with us.